everyone, welcome back to the online course Investment Analysis and Portfolio Management. Today is Chapter 4. We are going to learn about the capital asset pricing model. Now, let's begin with refreshing our memory on efficient frontier, which is the main crucial contribution given by the modern portfolio theory, which is the content of Chapter 3. Now, we say that efficient frontier gathers all the efficient investment choice for a given level of risk or for a given level of return. Now, it is being put into the dimension of standard deviation and expected return. We say that with the help of not being perfectly positive correlation, we say that the efficient investment choice on efficient frontier are most likely to be portfolios with two exceptions. That's their starting point and the ending point of the efficient frontier. Now let's talk about the starting point. It is a single asset instead of a portfolio. It has the lowest level of risk, yet still being a risky investment. Now, today, our theory, capital market theory, is built directly on modern portfolio theory's efficient frontier. The most crucial development is that we introduce a risk-free asset that allows us to bend efficient frontier into a new capital market line. Now, like every famous theory, we are going to start our conquer with the background assumptions. The most crucial assumption, which also connects the modern portfolio theory and capital market theory, is that we say all the investors studied by capital market theory are more efficient investors. So that means these investors would only target portfolios on, well, let's say, efficient frontiers. And their final location on efficient frontier depends on the tangency point between their utility function and the efficient frontier. Now, that is how we connect the modern portfolio theory and capital market theory together. Now, the second assumption, that is, investors are able to borrow or lend any amount they want at risk-free rate. Now, that is always true for us to be able to lend at risk-free rate because we can simply just purchase the treasury bond or treasury bills. It is not always being able to borrow at risk-free rate. However, this is only an initial assumption which can be changed in later analysis. The third assumption is that we say all investors have homogeneous expectations. That means they have similar, let's say they are looking at the exactly same probability distribution of expected return for a given investment. So their investment decisions are most likely to be cohesive. Now, the next assumption is that we say all investors have the same one-period investment horizon. So when we develop our capital market theory, we are using actually a single hypothetical time interval. And the length of this interval actually differentiates from being, say, 2 years or 2 months. That's why we regulate all our investors to have the same level of time interval in terms of their investment period. All right, the assumptions continue. The next one is we say all the investments are infinitely divisible in capital market theory. It means that it is able to buy or sell a fraction of the shares. We develop this assumption because we want to allow a continuous assumption, especially when we introduce alternative investments. Now, the next assumption is we say there's actually no tax or transaction cost involved in buying or selling the shares. Well, this is not that unpractical because for, let's say, pension funds and charitable foundations, they don't have to pay tax. And for financial institutions, most instruments, you don't have to pay transaction costs. So that's not a crazy assumption. It's actually quite general. It's a general description of what's going to happen in the real world. Now, the next assumption. We say there is no inflation or change in the risk-free rate, or if there's any change, they are fully anticipated. Well, that's a very initial assumption which can be changed later, so don't worry about that. And the last assumption we are going to talk about in this series is we say that the capital market is in equilibrium. So what does that mean? That means that every risky asset on this market are priced correctly according to their perceived level of risk. Now, these are the assumptions that help us to build a general case where the capital asset pricing model can be able to use to calculate the expected or required return of all the risky assets. Now, like I just mentioned, we want to bend the efficient frontier by introducing a risk-free asset. Now, risk-free asset meaning that there is no uncertainty towards its future returns. It has only one definite result. So, it has a zero standard deviation. Let's see how that happens, which is right here. Say, this is our expected return, and that's our actual return. For a risk-free asset, the actual return and expected return won't have any difference. So that's why the standard deviation of a risk-free asset is a zero. And also, because of this relationship, the covariance between a risk-free asset and risky asset also equals to 0 because this component equals to 0. So that's why covariance equals to 0. Now, if the covariance equals to 0, the correlation coefficient right here would also equals to a 0 because here that equals to 0. So we can get a very easy function here. That is, the risk-free asset has 0 risk, so it has 0 standard deviation, and it also has 0 correlation with any risky asset because they simply don't share any turbulence or fluctuations in common. And then we say that it provides the risk-free rate. So what does risk-free rate compensate? It compensates for two parts. The first is your time value of money, and the second is inflation. It only compensates for these two parts. Now, we say it has, well, let's just see the graph here. The risk-free rate is right here. So it stays on the vertical line of expected return, and it has 0 risk. So that's why it lies right here. Now here is our old friend of efficient frontier. And we can see from this line that capital market line is a line that starts from the risk-free asset, and it is the tangent line of efficient frontier, with the tangency point being the, well, market portfolio. That is a spoiler alert. If you find kind of lost right there, don't worry, I will get you. Okay, now, so this is what we can get when we can combine a risk-free asset and a risky portfolio together. So that is covariance between this risk-free asset and the risky portfolio. That is the correlation coefficient between these two. Now, this equation here shows the expected return of a portfolio that is formed by two assets. One is the risk-free asset. The other one is the risky investment, or let's say portfolio M. Now, we develop these two asset portfolio simply with one goal. That is, we want to develop the capital market line. But how? Well, stay tuned. Now, this is the standard deviation of this portfolio. Here is the variance of individual asset times weight, with weight being well squared. And then we have the covariance right here. So that is how we calculate the standard deviation of a portfolio, which is covered in Chapter 3. If you find yourself kind of fuzzy there, go back to Chapter 3, and I'll be right here. Now, we set these equations, but notice that the first part and the last part is actually equal to 0, because that's 0 standard deviation. That's 0 correlation coefficient. So these equations only have the second part to determine its value. The standard deviation of this portfolio actually is in proportion to the risky portfolio M, especially also in proportion to its weight. Because if this is the weight of the risk-free asset, then 1 minus 1 equals to the other. That's the weight of this risky portfolio M here. Now, let's do a quick transition here. Here is the expected return of this portfolio, and here is what we get from the last slides. Now, let's make a little transformation here. The weight of portfolio M would equal to that, and this one would be the weight of risk-free asset. Now, let's insert these two parts into this equation. This is what we have. Let's break the first bracket. Well, brackets. This is what we are going to observe if we break this bracket. Now, see how these two have this common factor here? So what we are going to do is connect these two parts, and we isolate it into this form. So that is the somewhat form of the equation for these portfolios expected return. Now, we don't stop there. We make another transformation from this form. Now, this is the equation we are interested in. It tells us that the expected return of this portfolio is given by the risk-free rate, which is compensation for your time value of money and inflation, plus a risk premium. So what's that risk premium is in relation to? It is in relation to the risk it carries. The risk it carries. Now, how about this part? I hope you can see that clearly in your slides. Now, this part actually tells us the return per unit of risk. The return per unit of risk, and the return is in excess of risk-free rate. Now, that equation here gives us the equation for capital market line. We say this is the equation for capital market line when this portfolio M represents the market portfolio. This relationship actually holds for every combination with risk-free asset and risky asset. But one particular form is we say that this risky investment is the market portfolio. When it does that, we say it is the equation for capital market line. Now, that is our capital market line right there. It is an upward line, starting from the risk-free rate, and then have a tangency point with portfolio M. The tangency point also lies on the Marquis efficient frontier. Now, that is our capital market line. Okay, so this is how we develop capital market line. We use a portfolio that consists of risk-free asset in combination with the portfolio of market. And then we are able to show that it is the tangency line of efficient frontier with the tangency point of market portfolio. Well, is that the new efficient frontier? Can we go any further above that? Well, stay tuned and find out. See you. Bye-bye.